Hello, everyone. I am Lisa Moore here with Retoro Capital Investments and my partner, Chris Borden. Chris, say hello.
Hello, everybody. We got to get a more exciting intro than just a weird silent countdown. I need some music or something to jazz people up. So,
Something
welcome,
flashy.
everybody. Glad to be here. Glad to be here with you, Lisa. We're excited. Got some kind of fear mongering things to sort of go over. But before we do that, we're going to have Lisa give us a disclaimer.
Yes. So just so everyone knows, this is not financial advice nor legal advice. We are not licensed custodians or advisors. We are just sharing our personal experience for educational purposes. As always, if you have any questions about anything that we discuss, anything we say, please make sure you consult a professional before making any investment decisions.
All right. So, Lisa, kind of give us a little bit of background of what we're going to be talking about today.
Yeah, so whenever we're doing these webinars, we're always trying to look at and figure out, okay, what is kind of everyone talking about? What are the things that people are going over right now? And in talking to our investors, a lot of the things that people are worried about are just the general fear to invest right now, not having the returns that we used to, or their money is still tied up in deals, they lost money on deals, so there's that hesitancy. So we want to go over we have kind of three main points that we're going to break down and discuss today. And those are, people are scared to invest. Number two, we're going to go over is about just commercial real estate in general. And we are definitely in a cycle of underperforming deals or not performing like they were, expecting to get higher returns, breaking that down. And then money sitting in the bank and why people think it feels safe, and going over some talking points on that. So
Yeah, I think we've all seen pretty much how unpredictable the markets has been. I think consumer confidence is at one of its lowest it's been in a very long time. I was just reading a report. I'm not even sure who publishes the consumer confidence report, but I was just reading that earlier today. There's the consumer confidence report as well as I think it's called the expectation index, and that's been one of the lowest too. I think anything that drops below 80 is like signals signs of of recession. And like kind of the goal here is to kind of help you navigate how to balance it. Like you never want to ever sit out of investments because I mean honestly, sitting out of investments probably I mean it's the same thing, right? Inflation's still there. And we don't anticipate inflation slowing down anytime soon. So if you're not necessarily investing, then there's opportunity loss as well. So just trying to put some expectations and navigate maybe as Lisa said, some of the things that we've probably our personal experience, like things that we've done, maybe even we'll probably even throw in. I think it'd be cool to throw in like maybe some deals that have not gone that well. And then like what does the overall portfolio mix probably look like, just from a general standpoint. So okay, so first off, people are scared to invest, but it's not if you should invest, it's how. So, I mean, Lisa, kind of talk through some of your opinions on how you would look at navigating this.
yeah, I mean, this really comes down to diversifying your portfolio to make sure that there's always cycles in real estate, and even within real estate. Real estate itself is not one big cycle. You have different niches. You have within commercial, there's, as everyone knows, there's retail, there's industrial, there's multifamily. So even within real estate, you have different cycles within different niches. So it's really just looking at and nobody can predict what's going to happen in the future, but we can make a best guess and look at what our financial goals are and look at what our risk tolerance is and make sure that we are diversified and that we are investing in things that are kind of the best fit that we can make for that market. You're never going to hit it 100%. You're always going to have times where you might be a little ahead of the curve, behind the curve, but making sure that you're diversifying and spreading between equity and debt deals, different niches, is going to help you weather these times where it might be rough. If you're 100% in multifamily, it could be a rough time. If you're spread between multiple niches, part of your portfolio might be taking a little bit of a hit, but other ones might be doing great. So it's making sure that you just have that balanced portfolio.
Yeah, I think to add on to that, so you talked about the cyclicality of things. Like that is not unique to just real estate either. I mean,
No.
all markets are cyclical and cyclical in nature, meaning that they go up and down. And kind of understanding, like, even again, I'll just take this even out of context from real estate. So we primarily do real estate, but I want to take it even out of context from real estate. I mean, a good asset allocator, and that's what it is, right? You're allocating your assets, so you have whatever capital you have, and you want to allocate it. And any great asset allocator, just take like even Warren Buffett, right? He's going to, I mean, he's the largest owner of the US Treasuries. I mean, it kind of tells you. And US Treasuries yields are 4%, but his overall net portfolio return is probably close. I forget what it was. It's been a while since I looked at it, but probably closer to around 15 to 17%. So it's about allocating the assets and making sure you allocate assets predicated off of. I mean, you want to get a good return, but you also want to protect against risk. And one of the things that you should also be looking at doing is like rebalancing, right? There's always times when you look at rebalancing your portfolio, depending on. You shouldn't ever try to time the market. Just I'd seen another report that talked about what made the most millionaires, and it was honestly it was about just steady investing,
Yep.
not trying to time anything, not trying to do anything fancy. It's honestly that's the boring stuff. The stuff that people don't like, that normally get people into the most amount of trouble because it's not instant. If you get rid of the instant gratification, you'll be able to grow your wealth that much faster. It's just you gotta be able to discipline yourself and get out of that again, more of that instant gratification type of thing. So
Yeah, there's definitely rarely instant gratification in most things, especially real estate. So like when you're looking at your portfolio, looking at growth, the stability and liquidity, kind of balancing those three things. And that's going to look different to everyone. Like I'm a more risky person. So being on the younger side and having time, like I'll have a much riskier portfolio than somebody that's in their late 50s that's looking to retire soon, that doesn't want to put their money and their capital at risk. So, and even somebody like, so I'm 41, but even somebody my age, they just might not be comfortable in really risky investments. And that's something that I think everyone, they need to decide for themselves. What risk level am I comfortable with? Because I wouldn't want to ever see anyone invest in something, even if it's a great deal, but it's risky. If it's going to stress you out, if it's going to keep you up at night, to me, it's not worth it. There's plenty of other things that you can grow your money in and have it be safer and not cause you so much stress and anxiety. So
I think the only problem is I definitely that is a valid point. The only problem is I think in general people don't know how to analyze risk. And when they're looking at the risk, like they don't know what is risky and what level of risk I'm taking on per the different investments that they're doing. I think if we could do a little bit more education structured around that aspect of it, I mean, I think it can definitely help people understand the different, because there's different levels of risk that you're taking on, and I mean, it does get complicated, but at the end of the day, it's just math.
yeah,
There's ways to calculate the risk that you're taking on, predicated off of, and you should be properly allocating that risk. You're allocating your return profile, which is what most people look at. Like if there's one thing that you guys can take out of this is look at the risk side of it, and don't only specifically look at the returns, because the return is just one metric that you're looking at. In general, this is not always the case, but in general, investing 101, the higher the return, the higher the risk. But that's not always the case. You definitely have to look at it and see, and there's different forms of risk as well, but there's ways for you to be able to analyze it and be able to allocate your risk appropriately. Because you guys should, even if you're older, you should be taking on a little bit more risk, but it just should be limited by the portfolio size. So if you have whatever your portfolio size is, and even if you're 55 plus, even if you don't want to take on risk, you should still allocate a small portion for higher risky ventures. Because you're going to grow your wealth that much faster by doing that. And then if one of those higher ventures hit, then you rebalance it back out again. You take the income from that and you rebalance it back out to less lower risk investments. And it's not overly complicated. I think too often times we take emotion into it, and then we emotionally make it overly complicated. So I think kind of a good segment or like a good analogy would be it's kind of like driving through the fog. You don't park on the highway, right? Because the visibility is low, and then slow down and turn off your lights, right? You keep moving forward, you keep pushing, because the goal isn't to necessarily stop investing. It's to drive and make sure that you make smarter decisions while you're driving. That's kind of the overall goal, and probably a perfect analogy to it.
Yeah, that is a good analogy.
Any last thoughts on like any more advice on people that are just scared right now?
I would ask, like, what exactly are your fears? Is there something that's happened? Are you just scared to get started? Like, what exactly is that fear? And what's feeding that fear? Because you can easily go on and you can find fear-mongering videos of the world's coming to an end, the market's going to crash, it's going to be the biggest dip, and you can find stuff that's like, this is the best market. Like, you can feed your mind both ways. So I would figure out, like, what are you really scared of, and what is that fear of the investing? Is it a history? Is it a mental thing? And then go from there and look and see, okay, what am I listening to or watching that is feeding these fears? Or what do I need to do going forward if I lost a lot of money on a deal or got really burned by a partner or something like that? Like, what are the things that I learned from those deals and from those partnerships that could help me move forward and still continue to invest? But I think knowing why you're scared and what those fears are, you need to kind of address those and vocalize those before you can kind of move forward and figure out, okay, how do I move past this? Because otherwise it's, how are you going to get over it? How are you going to move forward if you don't know what you're scared about? So
yeah, good point. Again, I think it kind of ties us into sort of the next topic. And I wouldn't even peg this just into commercial real estate, but again, because we're in real estate, it's more real estate focused. But I think commercial real estate deals have been underperforming, especially from what it was 3-4 years ago, right? People that have probably entered into some investments in 2022, 2023, they're starting to see some compressions. Obviously, the interest rate's been one, but underperforming rent growth has been another one. Underperforming occupancy rate has been another one. So because there's been a lot more units that came online, people are downsizing. As I mentioned earlier, consumer confidence is at its lowest. I don't think it's at the lowest that it's been the entire year, but it's teetering there. So I kind of want to talk to you some of that. That kind of makes sense. So you've been talking to several investors. Maybe you've even experienced some of it yourself. I definitely have. So maybe you can talk through like what you're hearing or what you're seeing on the commercial real estate side, and maybe kind of, just say that. Just go with that. Like what you've been seeing, what you've been hearing on the commercial real estate side of things.
yeah, I mean, personally, I mean, Salt Lake is a market that has definitely, we have units here, and we've definitely seen a drop in rent. We've definitely seen vacancies taking longer. So I think as for my active deals, we're making sure we have a much bigger cash cushion right now because vacancies are longer. Things are taking longer. There's so many units that have been coming online in Salt Lake. I have a friend that just moved back here, and she stayed with me when she's looking for an apartment, and she went out one day to look at apartments, and she's just going, holy shit, Lisa. She goes, I cannot believe how many apartments there are right now. It was just like overwhelming. And I'm like, it's a great time for you. I'm like, you can negotiate. So as it's great it's becoming a more balanced market for me as an investor, and for our active deals. It's not the fun, happy time of real estate. It's we got to grind. We got to get through this. How can we get our stuff rented? And that's happening even in the passive deals that I'm in. the occupancy isn't quite what it is. They've had to pause some payouts. Luckily, overall, like, we won't lose money on that deal, but the returns probably won't be as high as they were. And that's a deal in North Carolina, and it's similar situation. Just rents aren't growing as much as they had anticipated. They're really trying to get the vacancy up, and in order to do so, they're doing more concessions. They're keeping rents lower than what they wanted to. So it's not just a Salt Lake thing. That is a common thing in many markets. And to me, it's the cycle. You're never going to have, you just can't have the growth and the amazing market that we had several years ago. There's going to be these times. That's just the way it goes. But I think that's a common thing. I think that's a big issue with a lot of the commercial deals right now. There are some that I looked at that they were underwriting a 5 to 10% rent growth every year for 5 years. And this is a couple years ago. And I'm just looking, I'm like, that is way, way, way too aggressive. Like, unless if you are so far below market and that's how you're going to get people up to market rent over several years. But if you already have people at market rent and your plan is just to keep raising rents, like, it's just not realistic. So making sure, like, these deals that were underwritten like that, or now it's just being more conservative. Anything that we're looking at, we just bought an 18 unit less than a year ago, and we didn't underwrite any rent growth for the first 3 years. Will we have some? I don't know. Hopefully, maybe we will, but we didn't bank on that just because the way the market is. So I think it's things like that. There's a lot of markets that are seeing that, a lot of vacancy, and just things taking longer because there's more rentals available, especially in the Utah market.
Yeah, I mean, obviously, this is not no new news to anybody, but the asset's been under a lot more pressure because of the interest rates.
Yep.
And with the interest rates increase, especially the assets that were banking or had underwriting assumptions that on low rate assumptions, regardless. I mean, just take rent growth out of it and occupancy out of it, which is pretty normal. I think a lot of times, most of the assets that we looked at had anticipation of rent growth and maybe some moderate occupancy growth, or at least status quo. But then the interest rates alone was a huge hit, right? It took a huge hit to cash flow. I personally have been in a few deals that have gone belly up, lost several six figures, and it definitely stings. But like I said in the beginning, it's more about asset allocation than anything else. So it's kind of understanding and hindsight. I mean, we could have looked at the deals a little differently. And you always kind of learn and grow through attrition on the making sure that the assets are the right assets to choose. Now, these are not assets that we manage, but assets that I personally invested in, and not necessarily the correct market, and looking and kind of understanding too. Like I said before, markets. Well, I didn't say it. Lisa actually said it. Markets, asset types, they're all cyclical. They don't necessarily follow the same trend. You can have, and I guarantee there's markets out there that are still rocking and rolling, and other markets that are underperforming. So there's not a one size fit all. Globally, from a whole total economic standpoint, we're seeing more and more properties underperform, again, especially because of the interest rates. But it's more about asset allocation. So you're gonna have some, even if I was investing in the equity market, I'm gonna have, right? I look at my equity market portfolio. I have 75% of them are green, 25% of them are red, and then you relook and you re-asset. You take income from one, and you rebalance your portfolio. I mean, that's what investing should be. But because the larger portion of our total overall investments are in debt, I mean, it's still an overall year of a net gain. Again, there's some losses, but there's going to be some gains. And I don't care what anybody says, people are going to be wrong. No one is going to be right all of the time. People are going to make mistakes. Things are going to go wrong. Investments are going to go bad if you have enough investment allocation out there. But the goal is to make sure that you don't have, we've talked about this before, but you don't have all of your eggs in one basket. You have you spread it out, and then, like I said, you're spreading it out predicated off of your risk premium and your return. I mean, your return premium and your risk. So you kind of looking at it from that standpoint as well. I think more often than not, too, like people, I don't think people fully understand. I think that's something that's starting to be a little bit more popular. 2 years ago, no one was talking about it, but we've been doing it for a while now. We've been doing it before it was definitely a cool thing. All right, the real estate, the commercial high rises, these pretty buildings, they were all the cool things. And I think people are quickly starting to realize the equity appreciation is not guaranteed. Like, there's nothing guaranteed. I would see so many posts on, yes, all we have to do is add washing machines to the units, and now the value went up by $200,000, and look, you just got $200,000 by spending $20,000 in washing machines. That is definitely not the case anymore. You never see those posts anymore, but we do see a lot of posts on debt. So, kind of looking at it, it's understanding. So maybe Lisa, you can walk us through some of that, so the people listening can kind of get a better understanding between debt and equity and how those investments differ depending on risk.
Yeah, so to try and like do a high level of the difference of debt and equity. So if you, and we'll just keep it simple with like a single family home. You have a single family home that somebody is trying to purchase, and it's Utah, so we'll say it's $1 million for even numbers. So most of the syndications are their equity. So they're coming in and they're saying, okay, we need to purchase this, and you are basically going to be coming in that equity position, which gives you the good and the bad. So the risk comes in because if that deal goes well, then your equity portion could do well and your returns could do well. But if that deal goes bad, then you could potentially lose everything. You aren't guaranteed any returns. Where if you come in on the debt side, where it's basically like the bank, and they're going to get, say, a 50% loan, so 500,000 is going to be their equity partners, 500,000 is going to be from the bank. That bank is always the first to get paid. They're typically going to be in your first lien position. So if something does happen and you have to sell that property, or just in who's going to get paid out first, it's going to be your debt position. So you don't necessarily get the upside of that deal, and we can never say guaranteed, because obviously you could still potentially not get paid debt, but it's a much lower risk. But you're going to be that first paid, and like I said, you won't necessarily be getting the upside. So if that deal was a home run and they did way better than they expected, you're still going to be at your set debt, but you're also not going to be losing money. Where like a lot of these deals now, as everyone's hearing about, they're not getting the returns that they expected, or they're losing money. So your equity is definitely riskier. You're not sitting as good of a position as a debt, where that debt is typically first lien position, first to get paid. If that property has to get sold, they're the first ones that are going to get paid off. So if it's a deal that's not doing well, your debt's getting paid. And if there's nothing left to pay out to your equity partners, and you're that equity partner, you're that LP coming in, then there's nothing left for you to get. So that debt is always going to be a much safer position to be in as an investor, with more steady returns, but again, not the chance of the upside, but not the chance of the downside.
Yeah, I did have some comments in there that I missed. So Thank you, Chelsea. I think this is towards you. So thank you so much for the advice there. People follow, and yeah, this is true. People follow. I wish there was more education on risk, and there's not even. I gotta bash us syndicators and fund managers, because there's not even as much talk about the risk side of things, even from our standpoint. I think we tend to bring up the flashy things. Flashy things probably sell more, But understand, because risk is not, I mean, risk is not bad. It's understanding it. You take
Yeah.
on risk with any, you take on risk with not investing. That's still a
Yes.
risk. There's risk with everything. It's understanding the different levels of risk is like what we feel is like super important. I just wish that education would be out there more and people would talk about it more, so people can understand. Okay, I'm looking at this. I know I'm going to take risks. And again, if you sit down with your financial advisor, not all financial advisors are created equal, but if you sit down with your financial advisor, the first thing they should do is try to analyze where you're at on your investment journey and your risk profile. Like a lot of it's going to be, like Lisa kind of alluded to earlier, a lot of it's going to be kind of predicated off your age. It's not necessarily your age. I mean, you might have not invested your whole life, and now I'm 55, and now I have to get more risky because I need a specific return. If not, I'm going to be working the rest of my life. So it's all individual to each person and where they're at. So, but on definitely understanding the risk side of it definitely helps. I think it can make you make better investment decisions. So when times like this come to fruition and there's a lot of uncertainty, you sit back and you go, you know what? I feel good about my investments because I know where my risk tolerances are, and I know I have great asset allocation predicated off my risk tolerance. So that's kind of more of it. So I think I definitely like the how you pointed out about the investment. I think an analogy, kind of trying to remember that analogy. I know it had to be somebody naked, but I think the analogy, I was like, these are the types of times when the waters start to recede and you kind of see who's swimming naked, right? So Lisa and I kind of laughed about that the other day. What analogies can we stuck in? It's like, let's put the naked analogy in there. But it's true, right?
Yeah.
It's yet now are the times where when returns are not coming back to what they thought they would have, or even more importantly, or worse off, if investments just completely go belly up, which there is still a lot of that happening. You're like, oh my God, I had all of my investments in this one section, and what am I going to do now? Like, you don't ever want to be in that situation. You want to be in the situation where it goes, if you lost, he's like, dang it, I lost on it. Okay, I'm going to learn from this. I'm going to do better. But I have all of these, again, the allocation to where I'm comfortable. So, again, kind of looking at it, and don't swim naked. That's kind of the moral of the whole story. Anything else to add there, Lisa?
No, this last one's my favorite one.
Okay, you start on the last one then. This is your favorite
This
one.
one. So money sitting in the bank feels safe, but it's silently losing values. As we know, inflation and all that is happening. So I've talked to several people lately that have been investing for many years, and they, just it's always that mindset shift. So, making great returns during 2020, 21, 22, and you're making these awesome returns. And some of these were active investors. And so I'm in the same boat when we're looking at deals, and you're easily finding, you're like picking the best of the double-digit returns, and like, these are all great deals, like great deals everywhere. And now there's still great deals out there, but your returns probably aren't going to be as high as they were. And talking to people was like, man, I was easily finding, these double digit returns for me buying assets. And now I'm looking at stuff and I'd only be getting like a 6 or 7, maybe 8% return. And they're like, so, I think I'd rather just like keep my money in the bank. And I'm like, Jim, like, what is your money making in the bank right now? You're like, maybe 0.5% if even. And I was like,
0.2, 3.
yeah. And it was just that, like, they hadn't thought of it. They just kept comparing today's investments to the investments that they'd been buying, and not being able to find that same return. And just like, I hate to put my money in something that's not getting as much of return, not thinking to compare it to, well, would you rather be getting that like 6, 7, 8% return, or would you rather be sitting in the bank, or doing debt investing where you can be getting 8, 10, 12%, depending on like what you're investing in? And it was such like a light bulb that they're like, Oh, I hadn't compared it to that because they were just thinking the bank is safe and that's okay. We'll just keep it there until things start getting better and until the market, I can start getting those returns again. So there is a cost to keeping your money sitting in the bank. And now, do I think there should be a safety net and a cash reserve? Yes, especially like for me right now as an active investor with the deals we have going on, we're still stabilizing an asset in Chicago. So yeah, we have more cash now than we probably ever have, just because of the deals that we're working on and the market that we're in as active investors. But there's still that cost to just keeping your money sitting in the bank. If you're looking to invest passively and looking to continue growing your wealth, and if you don't need that big chunk of money for the reasons that we do, if you're just an active investor, you may not need to keep a big chunk of money in there. So, and back to the balancing, how much cash do you want to hold, how much investment, but just remembering the bank is not safe, especially with the inflation that's going on now. You can still be making investments, you can still be growing your money, and you can still be doing it in a safe way that makes you feel comfortable, even in today's market. And I think, I know, Chris, what are your thoughts? I think trying to compare returns and
I
deals that
think
were done years ago, it's like,
anybody that has money in the bank that's one that's wrong. Just to have money in the bank, like you have it in some kind of money market account that you can move it out, that you're still earning 3 to 4%. Maybe you just have it in a savings account. So you find a financial advisor that can help you navigate that. That's step number one. Step number two is I think you made a good point. I mean, there's two components to it. I think there's two components, because if you don't necessarily want to just get into investments, and you do want to somewhat strategize it, because again, if you're a savvy investor, and not to say I am, but just saying, if you're a savvy investor, you kind of know right around now is probably the better time to start buying, because you're going to have a lot better future opportunity, like as far as appreciation of properties. As again, it's cyclical, so we're looking at it like, never try to time it to be absolutely, I gotta wait, this is going to be the best time. It never happens. Like, it never comes out correctly. But having a little bit more cash reserves to deploy right now is probably a good idea. Or, like I said, have it in money market, or look for short-term opportunities that you can get your money back. You can get your money earning. You can potentially get your money back out quickly. Something that's more moderately liquid, definitely not like a 5-year value add apartment building. Not if you're not confident right now. But I think right now, like, there's going to be way more opportunities that continue to pop up. We see more opportunities coming to fruition now, because the assets that are foreclosing are going to someone else. Like, someone's picking it up at a pretty darn good discount. So someone's out there acquiring these properties that are going through foreclosures that the banks cannot handle. They're being acquired. It's not like, okay, we'll close everything down, people go find somewhere else to live, or we're closing the store down so nothing happens. And so that none of that's happening. People still got to live. It all keeps coming to fruition, and there's just more opportunities. So opportunity cost is probably a big thing as well. But I think kind of understanding what all your options are probably the best route to go. As far as all the reasons why we love debt so much, I like real estate in general, but I love debt just because, again, I know I'm going to get a payment, right? It's secured. There's a contract between ourselves and the borrower, and they're going to give us fixed payments at a fixed increment in time. We know everything that's going to happen. It's not up to, again, like the equity side, where we don't know and we have to make adjustments and cut back distributions. Like, none of that happens. So again, you're not going to get the upside return like Lisa talked about, but no one's getting it now anyway. It's not happening. So I don't foresee it happening in the next year. My gut tells me that everything stays relatively status quo for I mean, again, barring any large geopolitical issue, and we have a lot of them out there, but barring any large geopolitical issue, my speculation is everything kind of stays status quo, maybe slight. It depends on where you're at too. Maybe a slight backdrop to where we are, or a slight increase, but for the most part, pretty status quo. And and I think we can anticipate that for at least the next year. So I'm not going to want my money sitting in a bank for a whole year and not doing nothing. That is insane. So getting into debt instruments, getting into those opportunities, shoots, even like you said, money markets or treasuries, or I mean, anything that can perform better than what my money is currently doing right now are probably all good opportunities.
Yeah, definitely. If your money is at the bank and it's in just a regular savings account, just at least see what your bank has to offer, and at least put it in a money market that's getting a few percent, if that's offered, while you're looking at what deals to get into. Because you made a comment about the foreclosures, and I've talked to several investors, and even this past year at the Best Ever Conference, Joe Fairless was talking about all these properties that are getting foreclosed on. And just because the property is getting foreclosed on doesn't mean that it's going to be a good deal. I
That's
remember
true too.
him saying he was sent 6 deals from the bank, and 5 of them he would still have been overpaying, even if he took it over at the cost of debt. Like, that's how much people had overpaid for properties, how much of a turn the market could have taken, how unrealistic their projections could have been. There's a lot of factors that could go into why there is such a huge drop. So if you are an active investor, or if you're a passive investor, and if somebody is touting a deal that they're buying at foreclosure, don't assume that that means that it's going to be a good deal. You still want to look into it. You still want to do the due diligence as much as you can. But don't assume just because somebody's saying they're buying something from the bank and they're getting the cost of debt that it's going to be a good deal. So definitely keep that in mind. What else? There's another point that I was going to make, and now my mind just.
I don't know what that point was going to be. I look like I'm super dark now. Sorry, the sun went down. I don't have light in front of me. I just got very dark. I think overall, I mean, at the end of the day, I mean, yeah, I think there's going to be more opportunities coming to fruition. But regardless of the opportunities that come to fruition, at the end of the day, ultimately, it's about, I think, this is my personal opinion, so it is Warren Buffett's personal opinion, his asset allocation. Ray Dalio, his opinion, asset allocation. Like, it's really understanding the assets. I just got a message from Emma. Is really understanding the assets and looking at how you're allocating those assets that are going to make the whole world a difference. And it doesn't matter, right? Your goal is to win regardless of what the market is doing, regardless of the cyclicality of everything. Your goal is to win. So how do you make yourself so that you put yourself in the best position to win? And it's not always going after the highest returns. Right, it's looking at what you have to invest and making sure you're allocating correctly. Because, like I said before, there will be times you're going to get it wrong. There will be times your investors are going to get it wrong. I'm not your investors, but your advisors are going to get it wrong. So, say again, I'm looking at just the equity market. Like, I remember doing pull some research on, and this is specific to the equity market, but like fund managers, I think 20% or maybe 30% of fund managers actually beat the S&P 500. So I mean, that's a super small amount in the grand scheme of things. I mean, 70% of them are wrong more times than not. So I mean,
that's a higher percentage than I've heard.
That's a
on a consistent basis.
Yeah, on a consistent basis.
We're not talking like in a 1 year snapshot, like in a.
Oh no, in a 1 year, like in a 1 year snapshot on the equity market, I'm a hero. I think I mentioned I'm up like 105% this year alone. But it's not in the long run. It's just because the certain picks have been very well and have been performing very well. and then you reallocate the assets back out again. I pull some of that capital back out, put it into more safer investments, and you keep rotating that over and over again, because I guarantee there's going to be a time where we're wrong and those assets start to drop. So yes. Oh, look, and then there was light.
And then and I definitely agree with what you said on the market. And like we said, none of us know what's going to happen, but I do agree. Like, I don't see, short of any major political situation or whatever, I don't see there being any major shifts in the market. There just doesn't. There's just, to me, there's just nothing like pointing towards that. So like when I'm looking at stuff and I'm looking at my portfolio for the next couple of years and what we want to do and what our goals are, I'm assuming that things are going to be staying status quo. I'm not anticipating big growth. I'm not anticipating, okay, awesome, we're in a year, we're gonna be able to start cranking up all of our rents. No, like we actually just signed a lease with somebody guaranteeing them that we won't raise their rent next year. Like for us right now, like to get tenants in to get our vacancy, we have, I think, 2 vacancies right now in Utah, to get those filled. And we're comfortable doing that just because we just don't see that happening. Like we don't see there being this big shift in the Salt Lake market where we're going to be able to do big rent increases next year. So for us to like get the tenants in, vacancies are our biggest expense. Vacancy and turnover are our biggest expense. So if we can do anything to help alleviate that, and if you're an LP and you're invested in deals, ask your GPs, like, what are you doing to lower vacancy? What are the things that you're doing to try and get tenants to want to sign that lease and then to keep the tenants that you have? Because we're doing everything we can to not lose tenants. You know, we have a tenant right now that her lease is up in the spring and they need a bigger place. She started dating someone, they're getting married, they want a bigger place. So we're already looking at like our other units that are bigger than that one to see when those leases are due, to find out if they are going to be staying or going. Like we're always kind of looking at, can we move tenants around that want to stay with us but just might need a bigger place or a smaller place. So don't be afraid to ask, like if you're in a deal, whether it's a big syndication or a small partnership or whatever it is, whoever's operating that, asking them like, what are they doing to keep up with vacancy, to keep the tenants? Because that is, man, that can bleed you. Our 18 unit right now, we just had to fire our property manager. It's bleeding us. They've been terrible. We've been asking on certain tenants about an eviction. I probably have asked 25 times now. They still have not answered. Like, poor management can really hurt your asset. And we definitely have an asset right now that we're getting very involved in and getting new management because they're not doing a good job and it's bleeding us. So you have to be really, really careful with the operations of any asset you're going into, and making sure you're asking those operators what they're doing and making sure they're operating properly.
Absolutely. Okay, so for my final analogy, I think cash in the bank is like a parked car. It might look nice, but it's not going to get you anywhere. So that's my final analogy for the night. I was in charge of analogies, just FYI. So, any closing words? Somebody want to get in contact with us? How can they get in contact with us? And maybe just any final words of wisdom for anybody listening out there.
Yeah, I mean, I'll just kind of reiterate kind of what I said before with, you know, your risk level and your fear investing. You know, really find out like what's driving that fear, what's causing you to prevent yourself from investing. And then just looking at how you can diversify, how you can take your portfolio and still have it investing in deals that are going to be successful for you, whether that's equity or shifting more to debt. And just knowing what your portfolio needs to look like for your risk tolerance, what your goals are, what you're working towards. And yeah, I mean, you can talk to 10 different people and they can give you 10 different bits of advice, which I think is good. Like you piece that together because everyone's going to have a different investing philosophy. I mean, even my husband and I, we have different investing philosophies. So people can give different input and you can really be like, okay, that I agree with, that makes me feel more comfortable, or no, I don't like that. Like, the more people you talk to about these things and educate yourself, to me, will help you really guide like what will work for you, what's a good portfolio allocation. And we will talk all day, every day about this stuff. You can go to RoToroCapitalInvestments.com. We have a bunch of resources on there. It's investwithrti.com if you want to book a call with us. So don't hesitate to reach out to us, or just educate yourself. Listen to more podcasts, listen to more webinars, but letting your money, unless if you have a very, very, very good reason for letting cash sit there, like we have cash sitting there because we have a property that's bleeding us and we know we're probably going to need more cash than we're anticipating. So unless if you have a really good reason, if you're just scared to invest that cash sitting in the bank, really dig into why, because that opportunity cost could end up being a lot more than what you realize if you don't invest that for several years.
That's kind of a good point. You talked about the why. I think that, and goals. I think that's all. That probably takes it a long way. I would say kind of reverse engineer your goals. So we talk about it a lot of times. Just, real estate's great, or whatever. Investing is great. It's a resource or a way for you to get money, and obviously money's great too. But that's too is just it's a tool for something, right? It's a resource for something. So kind of figuring out what that is for you, and then reverse engineering it and working your way backwards, and that might help too. Like sometimes. I remember sitting down with a friend of mine. I don't even know if I brought this up before, but I remember sitting down with a friend of mine a few weeks back, and he just wanted some advice. He wanted to know if he can retire. He was worried. He didn't know what he could do, what he wanted to do. So I sat down with him for a few hours, and we just went through everything. Like, okay, tell me, what are your expenses? It's not hard. Like, at the end of the day, like I said, it's just math. Right?
Yeah.
Maybe you're bad at math, and find somebody that's good at math and sit down and talk through it. I figured out what his finances were, figured out, okay, how many times do you want to take a trip to Thailand or wherever you want to go? I figured it all out. Like, what do you want to do? Is there extracurricular things? You want to buy more things? Hey, these are all the things I want. I was like, yeah, let's just list it all down. And I was like, man, you can retire tomorrow and you'll be fine until you're 92. Are you going to live to 92? He's like, no, I'll die before that. I was like, you're fine then. So we're good. I said, you just never know. But it was a fun conversation. But kind of reversing it back, and then make sure, like, you don't always have to go for those home runs. And I think that's the problem with how we look at investing, and we're always trying to get the home runs, and we see the flashy things, and it 9 times out of 10 gets us into trouble.
Yeah.
So try to understand it. Like, why are you investing is probably the biggest thing first, and then go back from there, and then just try to piece things together. Find somebody that you can talk to. I think Lisa's advice is really good. Like, talk to more people, watch more webinars, listen to more podcasts, and then you start to form your own opinion. Don't just chase the shiniest object that you see. I know it's hard to do that, but that's my one piece of advice: is don't just chase that shiny object. Educate yourself. The more you educate yourself, the better you're going to be, the more powerful the decisions that you can make. So I appreciate you jumping on, Lisa. Albeit 2 minutes before we went live. Appreciate the suspense there.
I'm always there. You sent me a message that my phone said I got on Saturday. I had the screenshot to prove it.
She does have a screenshot to prove it. But I appreciate you guys coming on. Appreciate everyone that was in there listening to us. Thank you guys. And thank you, Lisa. We'll catch you guys on the other side.
Okay.
Aloha.
Good night.